All right, welcome. This is Millennial and Boomer Money Concepts, where a millennial son, which is me, and my boomer dad, we discuss money, stocks, side hustles, everything we agree and don't agree on, so you can figure out exactly what works. And this is our first video, and the format is going to be twice a month, typically the first and third Saturday of the month. We'll have a newsletter that drops. It's going to have a high-level outline of a money concept and as well as the stock pick, and then it's going to lead to a more detailed video where you can click it, and then it goes to a video like this. And don't just watch, join the conversation inside the MBMC Money Community on Skool. It's only $5 a month, and if you bring 2 friends, it basically pays for itself. A link will be below. So today is going to be really investing for retirement. So my boomer dad is going to go over a stock pick, and thank you to Fast Graphs for allowing us to show the software, which is very awesome. When it comes to stock selection, investing for retirement, what you want to understand is you want steady growth, you want a fair price, and a moderate dividend. I would say ideally 4% or greater, and also look for a good management team. In fact, actually I can't read my dad's writing because he actually bullet pointed it out so I could say it and sound smart. But Dad, is there anything else to add when it comes to investing before we get into the stock pick investing for retirement?
In a nutshell, that's it. There's a lot of more sub topics we get into later, but with that background of the steady growth, the dividends, great management team, we're offering a pick called Rexford Industry for our first pick.
Dad, shouldn't we do the disclaimer that we're not financial planners?
Yes.
This is for educational purposes, not investment advice. We are not financial planners. We just had to get that disclaimer out of the way.
Sounds good. Okay, so one of the stocks that both Dan and I have in our portfolio is called Rexford Industries, and I'm going to just cover the history of the stock before I tell you what it does, because we're looking for one of the first screens with steady growth. So this starts in 2014 and goes on to 2024, mid-year. That's where we are right now, where the shaded line is. And then you have expected earnings and dividends going for the next 2 years. So if you look at the stock, in fact, the price of the stock is this black line, and it's of course gone up, and then it went down, it went way up, went up again, and it's on a downtrend now. So that's where the stock is. This line, the yellow line, is the dividends it pays. In 2014, it paid a 48-cent dividend per share, and it went up to 51 cents, 54, and it goes up a little bit each year, like maybe 5% growth. Here's a big jump from here to here. It went up like 30 cents in dividends, another 30-cent jump in dividends. And this is what they expect to do in the future. Right now it's at 167 per share per year. So that's this line. Now, Warren Buffett, who of course everyone probably knows is one of the best investors of this generation, he wants to buy a stock at 15 times earnings. So based on the earnings of the company, or in this place, the cash flow, that's where he would think the fair value is. He'd want to pay this and no more if possible. The blue line is the mean of where the stock is and the earnings, and this is where the market values the company. And you can see it's much higher than the Warren Buffett part. And as I go into the detail, you'll find out why it commands a premium. But you can see now here it was way, it was $78 a share in 2022. Now it's down to 36. basically got cut in half. May or may not be a good deal, depends what's going on. But notice the fundamentals have been improving. They're expected to improve. So I think it's a good bargain here. It's never been as low as the Buffett indicators. It's as cheap now relative to earnings as it's been back to 2015. The idea is that, in fact, this little dot is where Dan bought the stock. He bought it at $33, and right now it's gone up a little bit. We expect it to grow a little bit by earnings. And this is another part of fast graphs that's really good. This is what they expect to earn. Well, you might want to say, well, how good are those earnings forecasts? So we can look down here on the analyst scorecards, the people that make these estimates. On the 1 year estimate, so that'd be out to here, or maybe this one, they beat these estimates 18% of the time, like 1 in 5. They hit them 72% of the time, and they did miss less than 10% of the time. They would miss on those earnings. For the 2 year forecast, which is out here, they beat it 10%, they hit it 80%, and they missed 10%. So that's pretty good. You're going to have you'll be hard pressed to find 100% hit. So I'm pretty confident that they will meet these estimates over this term. So to me, this is a stock you can buy and forget about. You don't have to check it every day to see what's going on, because we expect if they meet these forecasts, it should be trading somewhere in this range. And this is $60 a share. It should be somewhere between here and here potentially as it goes up. Now, of course, they can go down. There's no guarantee. Today, and it's July 28th, the close was $36.96, which puts it right here. Now, let's get into now what the company does. That's obviously.
Actually, Dad, what does the AFFO thing mean?
Okay, this is a great deal. AFFO is adjusted funds from operation. If you had a general stock, let's say you had a stock like Apple, it's a great company. What drives the price of the stock in Apple's case is earnings. So they have adjusted earnings per share. And notice here how great this stock has been. It's started here under the 15, and then in 2020 it went way up. It did great during COVID, went down a little bit, jumped around, and now it reached a high at the end of 2024, and it's down a little bit. But notice again, this is the price of the stock relative to earnings. We can also say, well, how does it do versus cash flow? And based on cash flow, it's higher than to be expected. But the reason you value a company like Apple and industrial by earnings is because that's the most important metric. Going to Rexford, which is down here, in simple cases, cash flow is the earnings, but then you add back depreciation, because like Apple has computers and things, they depreciate those, because over time, a computer that they have today is going to be worthless in 5 years. But property, like Rexford Industries has property, we'll get into what property is later, the property actually goes up. So what you do is add back in depreciation to get your cash flow, and that's your adjusted funds from operation. We could value that by adjusted earnings, but notice the price doesn't follow the adjusted earnings very well. For a real estate investment trust or REIT, it's more accurate to value, see the stock price pretty much matches the cash flow or funds from operations. So that's a long answer to what does AFFO mean. So when I talk about REITs, real estate investments, will be evaluated based on AFFO. And you can see it's been steady growth, except for there was a hit in 2015 and a small hit in 2019, but since then it's gone double-digit growth and expected to do single-digit growth over the next 3 years. Okay, so let's talk about what the company does. So Rexford has industrial property, and They only do property in Southern California. This is a map of LA. We have San Diego down here. Santa Barbara's up here. Notice the density. These little dots are all their properties. And they have a lot in Long Beach, the Valley, Thousand Oaks, Riverside, there's some, Oceanside, Carlsbad, San Diego. But the bulk of it is right here. And this is where Dan and I live. And this is pretty much landlocked. There's not a lot of vacant lots to build. So pretty much there's a buried entry because these are the properties they have. This is in Pomona. You don't find vacant lots like this in Southern California. So this is just one property they have in Pomona that you can actually call them and rent it if you wanted. But I like the area. If you look at the LA area, I've heard it said that California it'd be the fourth largest country. If California were a country, it'd be the fourth largest economy behind the U.S., China, and I don't know who the third one was. So, and Southern California is the bulk of that, of course, San Francisco. So the idea is that they're going to need industrial space. Amazon's going to need it, Walmart, all the companies to deliver from here to there needs this kind of property, and Rexford has these available. And it tells you here, if you were looking for property to build, if you're a Walmart, here's the square footage they have in La Mirada. Sylmar is up in the valley. And it goes on and on of what they have available. All of it's Southern California. So I'm very high on that. Real estate's gone up a lot, and I expect it to continue to go up long term. It could go down short term, but I suspect 5 years from now, all these properties will be worth more than they are now. So that's the geographic area, and they have industrial property. So it's pretty much tilt-up buildings with large garages to store stuff, and they're not in like on big streets like Beach Boulevard. They're back a ways because they ship from here to the storefronts, Walmart or whatever, or even the Amazon fulfillment centers will take their trucks here and then put the stuff other places to deliver to the customers. So solid model. They spend money keeping their properties in good shape. So let's go over the criteria that we have for stocks that Dan started with. So steady growth. Where did that go? Steady growth. In fact, even if we take up 2015, let's go back a couple of years, take up 2015. So here, since 2015, one small year, they've had steady growth. They've had that. The dividend it offers now, today, if you bought it today at $36.96, you'd get a dividend of 4.65%, which is, I think, a pretty good dividend. The management team, be able to put this together and keep this going for so long, he has a great management team. And even by the Buffett indicator, he'd pay 15 times earnings. Right now, the AFFO, it's 18, which is higher than 15. But notice it's never been lower, and that's because of the fundamentals of the company. Also, I like to see companies with very little debt. So the long-term debt to capital is 23%, very low for a REIT kind of thing. So I would, in fact, we both have put our money in it. In fact, Dan bought almost the absolute low. Let's just say if it goes back to the historical average in 2 years, if it goes from here to this, which it may not do, there's no guarantees, that'll be an annual percentage rate of 40%. And the stock will have grown by 117%. And it will, if you had $10,000, it would have given you $1,200. So 12% would be the dividends you got for this period. That's the 4.5% for like almost 3 years. So it probably won't do that, but let's just say there's a forecasting tool on here. I expect it to go higher. Let's say it goes up to just 19. Even at 19, which I think is fair, you're looking at a 12% annual return of here. If it goes to 22, so we probably won't hit 33, but even if we hit one of these, let's say get 21 times earnings back here, you're going to be making 15% on this stock at that range. And it tells here's the analysts that report the stock. There's 12 analysts reporting the company, and they project it's going to make $172, $1.81, $1.90. So this to me is a stock you just buy and let it run. You don't have to check it every day, because in 2 years, the best analyst or guest is going to make, instead of 196, it's going to earn 224 in cash flow. So it probably is going to be somewhere in here in the earnings, in the cap. So if it can just meet the forecast and do what it's doing right now, we're in good shape. Of course, anything can happen, but I'm betting on the future of Southern California. I'm betting on industrial real estate, and this is a great pick to add to your portfolio if you agree with those concerns. Any questions, Dan?
That pretty much covers it. One thing is we could go over is why real estate investment trusts as a category versus like energy or e-commerce. So could you go into why you prefer REITs category over those other sectors?
Great question. For investment, what you want to do is get rich slowly. Warren Buffett's first indicator is don't lose money. Now, obviously you can, but he doesn't like to lose money. Let me do a graph of Bitcoin just to show you it's another investment. Okay, here we go. Here's Bitcoin, which you can argue if you bought it back in 2015, you could have got it for, well, not pennies, but it looks like $500 in 2015, 2016. And notice it rode up to here. It got up to $12,000. So $500 grew to 12 or 14,000. Went back down, roller coaster up and down, big up, big down. In fact, that was from 60,000 for a year. It went to 15,000. So you lost 75% of your investment. But since then, look what's happened. Now it's up to 118,000. So looking back, that would have been a tremendous stock to pick. But for an investment portfolio, if you were in your 40s and say 50s, if you happen to buy it at this, not right here, 60,000, you'd be devastated when it went down to 16. Because at this point, you don't know it's going to be going back up. So you've lost 75% of your investment. So it's far better to pick a company that's going to grow slowly but consistently. And that's what Rexford offers. And of course, it can go down too. In fact, if I showed you on Rexford, if you bought it here, which if you had fast graphs, you never would. If you bought that stock here and sold it today, you would have lost 44% of your money. So even this company could lose money, but the reason you lost wasn't because the company didn't perform. It did perform because you paid too high a price. And if you look at AFFO, the price usually reverts to the mean over time. So it was way over the mean, went under the mean and back to the mean. It's going under. It'll probably, no guarantees, get back to the mean. So real estate is a get rich slowly deal. The problem with Bitcoin, it's a gamble, and it can be a tremendously good gamble, but you can also put your money on 33 on the roulette table and make 30 to 1, but you could lose. So I would not put Bitcoin in a portfolio for retirement. Now, if you wanted to put $1,000 in on a gamble and see what happens the next year, have at it. But in an investment portfolio, I prefer steady growth, dividends that you reinvest in the stock, great management teams that have performed in the past, and buying the company at a fair value, which is not in any of it wouldn't be here. Now, it's true, if you look here, it's overvalued. You could have bought it overvalued here and sold it here. You could have made money, but you're gambling. You want to buy them when they're undervalued. And that's what Fast Traps graphically shows you. Okay, long answer to a question. Any other questions, Dan?
No, thanks for joining us for our first stock pick. We'll see you next time for our second stock pick. Any questions you have, you can leave a comment if you're watching this on YouTube, or reply back to the newsletter issue, or join us in the MBMC community on Skool.